We have selected 7 great small cap stocks for 2025. That could possibly double. They could even go X5 or even X10. There's one stock that I have a lot of confidence in, and I truly believe it has X10 potential. I also bought a share myself, and I'll show you proof of it in this video. Who am I? My name is Jorik Vermeulen, entrepreneur and investor. I started when I was 23. Now with more than 10 years of experience in investing, I naturally make a lot of mistakes, but also have many successes, and we share our successes and mistakes through YouTube, as well as through our companies, Happy and Business Investors. If you're interested in our share, then check out the website. First, before I show you these 7 amazing small cap stocks that you definitely want to take a look at. So, watch the video carefully and leave a comment if you have any questions. I want to ask you a question, namely 83% of you do not subscribe to our videos while we put in a lot of enthusiasm and passion. Also, do a lot of research on stocks in the hope that you become financially successful thanks to our research. So I would really appreciate it if you could take a moment to subscribe and also like the video. That helps our algorithm. And as our YouTube channel grows, we can generate more money. And that money can be invested in better quality videos, but we can also expand the databases and tools that we use, which will make us even more interesting. We can update content with you for financial success and to become financially free as a means, not as an end, because the goal is, of course, to live happily and to enjoy what you do. The work you do should also be enjoyable and just a nice way to live, of course. But financial freedom helps us enjoy that more, and that's also why we make these videos as inspiration for further research. And these 7 small cap companies could really explode. But keep in mind, these are always small companies, so if things go wrong, they can go really wrong. That means the risk level is higher, and a higher risk level means more uncertainty, and therefore also makes it harder to predict, which could lead to downward declines. In other words, loss of money, and the real risk is potentially permanent loss of money. So be very careful. There are 7. Maybe you should invest in none of them, or maybe you know one that is great as a company that you also have more knowledge about. Then, I'm glad and I've helped you well. And also let us know what you have expertise in. Share it in the comments. Let's help each other grow, and thank you. Let's now take a look at the 7 interesting small cap companies for 2025.
Every now and then, you come across a fantastic small cap stock that could potentially go up tenfold or more in the very long term. And one of those companies is Candy Partners Group in terms of potential. We don't often find these kinds of interesting stocks, and in a short analysis of just a few minutes, I'll show you why Candy Partners could be very appealing for long-term investors who are willing to take a risk. Now, very interesting, if you go to the Candy Partners website, you'll find a number of crucial information sources, and very entertaining yet informative is the owner's manual. And the owner, Brad Kelly, has actually put together a textbook owner's manual. Not only will you find an overview of the company here, but what they do can be summed up in a nutshell. They acquire a lot of accounting firms. Here we see the revenue CAGR over 15 years. It's a serial acquirer, in other words, a kind of private equity-like firm that at the very least engages in buy and hold strategies for significant accounting firms. Right now they're still small, but as they continue to grow bigger and bigger, the acquisitions will also become larger and larger. It's a flywheel. There are a number of really interesting things in the owner's manual, and they are looking for example, quality shareholders. Yes, the explanation of the strategy, the business model is very interesting, but especially that these are also accounting people themselves, so they are very good with numbers. That also makes it very difficult to value this company. The official ticker is KPG, Candy Partners Group. The current market value in my own portfolio, well, not with DeGiro, but with Interactive Brokers, I have 2 accounts. Here's my market value, 8,000. We see that the total return at the moment is 26%. I only took a position last summer in 2024. Recent figures show that the revenue has grown again by about 30% year over year. It's going really well, but the stock is very difficult to value. I don't actually have the exact answer, to be honest. I bought here because I do believe in the management, even though it might look too good to be true. It might look too polished. Brett Kelly as CEO also literally looks sharp. Maybe a bit too sharp. Time will tell. I really believe in this company. It's one of my larger positions within my Interactive Brokers account. A few things, as we can see in the fundamentals, is, for example, Morningstar. It only gives 2 stars. The fair value is therefore $8 Australian. The current price is already a bit higher at the moment. That's also a very important point. 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 They have risen again. We can see that reflected in the prices. And for example, the earnings have increased significantly. The current price earnings is not 67, but that's 170. The price earnings of 67 indicates the future forward date next year. The price earnings of 67 indicates the future forward date or next year. But what's more interesting with serial acquirers is, of course, to look at the cash flow. Cash is king, that's everything, and that's why the company is really very difficult to value. For a long time, the price to cash flow was around 10. I took a position somewhere around the summer of 2024. Actually, my price to cash flow was 15, so not even superior. Now, the price has risen a lot, so the price to cash flow has also increased very quickly. For example, EBITDA has also increased rapidly. At first, there was a price to EBITDA of around 10, and now it's already 13, and still actually relatively low compared to a lot of other share world acquirers in the USA. But Kelly Partners Group is perhaps a bit riskier because it's just a smaller player and also not in the USA, so the valuation is therefore a bit lower. When it comes to forecasting, to be honest, there's not much to say, so we'll skip that quickly. A few key statistics. The price to earnings right now is around 170. It says 135 here, but that's not correct. It's 170. As a result, the price to cash flow is a bit higher on the higher side, and the price to book ratio is very high in this database. Now, it's very important to understand that it's a small cap. The current market value is not 300 million, but around 480 million, as it has recently increased a lot. And you can also see that the reliable databases we usually use for this stock aren't even that reliable. It just has to do with the fact that this ticker is not really known. The KPG is the original ticker. Here you also see a completely different ticker. It's just a small under the radar company, but very interesting. And what I find particularly interesting is the application of private equity, their accountants. So they know very well how to handle the numbers, and they try to keep the profits as low as possible, which explains why the price to earnings ratio is so high at the moment. Nevertheless, the EBITDA margin is above 20%, and that's really good. And not only that, but they've been doing this for 5 years in a row while also achieving impressive growth, as we've seen. Return on equity is, of course, super important for private equity firms, but return on capital could be a bit higher as well. However, that should increase over time. Kelly Partners Group has risen significantly at the moment. Yes, the current price may have risen a bit too quickly based on the latest news. I took a position here at some point, but I don't remember exactly when. We saw the total return, which was 26%. So that was somewhere in the summer of 2024, and really with the intention to hold it for the very long term. So I've taken a relatively smaller position. It was around 3 or 4% in total, and the market value has currently also risen to 8,000, so that's about 3%. We'll see, time will tell. I think Kelly Partners Group is very interesting for the long term. Maybe not so much for the short term because of the recent rapid increase, but definitely for the long term. Now, do you want more of these kinds of ideas? Check out our website, go to the Happy Investors website, check out growth stocks. We offer analysis for growth stocks with monthly growth stocks that have potential exponential returns, but also a monthly update on top growth stocks or other packages that we offer. Are you international or do you prefer it in English? That works too. Then check out businessinvestors.info roughly later. We offer exactly the same services but in English because we are also active internationally. Thank you for watching. Let us know what you think of Kelly Partners Group. Definitely check out the owner's manual because it's super educational as an investor and it's worth investing your time in. Opify is a very promising stock for 2025, although it's risky and it's also a small cap company with a certain level of uncertainty. Moreover, it is currently benefiting from the strong momentum in finance, specifically in lending, because Opify is an online platform for loans and credit provision. Now, the Morningstar rating gives it 4 stars. I'm curious why that is because the fair value estimate is below the current price, as you can see. However, analysts, and there are only 2 of them, also provide a higher price range, although it's not very much. But right now, Opify scores high in various screenings and databases. A lot of investors are taking advantage of that. So it could very well be that the momentum is going to increase significantly, especially because it's such a small under-the-radar company that benefits from strong upward momentum in lending. The current price to earnings ratio is around 9 to 10. Now, based on the fair value, it should be a bit higher. What does that mean exactly? Let's take a look at the forecasting. Now, a price to earnings ratio of around 10 with growth which is actually still very small and limited growth, estimated for the end of 2025, would justify a higher price to earnings ratio even with limited growth. That does mean that the return could be 35% in just 1 year. I wonder if it's a really good investment. Content-wise, I don't know OppFi very well. I wouldn't label it as a long-term investment, more speculative in nature indeed. But here might be an opportunity for those who know the company better. What stands out is that it scores very high on the factor analysis, the quant rating from Seeking Alpha. By the way, also check out our descriptions in the YouTube description. You'll see a number of links, including an interesting discount link from Seeking Alpha, which gives access to one of the more reliable databases that we use. RPFI doesn't have a lot of data in the system right now, so I would be a bit more cautious about that. But they are looking at a lot of stocks, approximately over 4,300 in total. OppFi currently scores 3 out of 685 stocks in the sector and is also number 1 in the industry. So it could be quite interesting to do some research on OppFi, especially for the growth. EBITDA growth for next year is estimated at 46%. Very interesting. There are a few characteristics. I've been using Seeking Alpha for 4 years. I can say it, but I don't think it's that important. Because for me, a red flag is the profitability, which is still very low. That might rise a bit in the future due to the positive momentum. I would still be cautious about it. Smaller companies, small cap companies, it's all still uncertain, and they can rise very sharply or drop just as sharply. However, I have my doubts about the long term. In the short term, it looks good. It seems to be a strong buy based on factor analysis. It's a strong buy based on a rank of 6. They are giving a price target of around 9.25. And also, if you look at the technical aspect, fundamentally speaking, the price earnings ratio is under 10, so that's not super high. You can see that after a scandalously bad IPO in 2021, the stock has dropped hard by about 81%. Here it was definitely much more interesting to buy, but you really had to be brave with a company that isn't very well known and is also active in the lending market with a lot of competition. It's basically just a commodity product, so you have to be willing to take the risk. And in that perspective, there are possibly much better companies out there. However, purely based on technical analysis, we see a strong increase in momentum. And it's very interesting when this price rises above the IPO price or the SPAC price, however you want to call it, the IPO price, because then the number could still rise a lot further. Now, this seems to be a mental resistance level for technical traders, so that means an increase of about 10%. If it rises above that, then that's another 18% increase to the IPO price. I'm curious about what happens next. Risky, speculative, not a great stock, but time will tell. An amazing stock that you probably have never heard of is FitLife Brands, and this is a great small cap stock for the very long term. At least that's my belief. FitLife Brands isn't even available through my current broker. It's really a very small company. The small cap company has a value of around 150 million. What does this do? This company sells all kinds of products for losing weight, building muscles, fitness products, and of course supplements. You might think this is not interesting at all, it's a commodity. That's right. But the investment thesis isn't about what they sell exactly, but how they do it. This company has been taken over by an interesting CEO with a high level of insider ownership, but the reason it attracts me is the fact that they do a lot of acquisitions, strategic acquisitions. They have a number of acquired brands, Dr. Tobias with a reasonably good position in Amazon, but also Muscle Farm, for example. And here they have shown the team that they were able to make the acquisition in a way that, for instance, Muscle Farm was in a lot of trouble. And the strong management team has turned it around with now a lot of success and profitability. We also see the new CEO who was hired in 2018, and since then, there's been a significant increase in revenue as well as adjusted EBITDA. And step by step, more and more strategic acquisitions are coming in. The latest software acquisition was particularly significant and they handled it very well. I've been following the company for quite a while. Now, if you want to follow more of these under the market, under the radar opportunities, I would say, of course, follow our channel, Happy Investors and Business Investors International. A lot of people don't subscribe, but I would appreciate it if you do. Why? If you ever enjoy our videos and they help you, like for example FitLife Brands, and it brings you a lot of returns in the future, then it's a small effort to just subscribe. Why? Convenient. Our channel is growing, which allows us to generate more income through YouTube. create more higher quality videos, and also do more research into topics. So everyone wins, especially you. My current position is only 1%. Why? Yes, it's risky, speculative, a small company, but especially the market value is only 150 million, and 1%, 1,000 euros in this case, in 150 million market cap, that can easily go up tenfold. Then you have 1.5 billion, and it can also easily go up 100 times. Then you have 15 billion. But before it achieves that, yeah, that's still a long journey ahead. But they are on the right track, and investing when they are very small obviously offers much more upside potential. That's why I find FitLife Brand so interesting. Not so much because it's a super amazing management team, although I do have a very good opinion of the CEO, but especially just the timing. It's still a really small company. Almost nobody knows it. Really under the radar. Now, Morningstar, I wonder if they really researched it. That's probably not the case. The fair value estimate is 26 according to them. The current price is 32. You can find the stock from scraps in the database. The current price earnings ratio has gone up a bit, but mainly focuses on growth. So based on historical valuation, it seems to be slightly overvalued. A purely simple forecasting methodology with the earnings per share growth projections around 20%, which I think is realistic due to the recent good acquisitions, but also just the superb management execution, even with the current price earnings ratio, which isn't super high, and let's say it stays at 17. Could this stock achieve an average return of 20% over the coming years? Now take a good look at the Attentive Investors presentation. You'll also find all sorts of figures in there. And here you can also see the annualized returns up to December 2010. And you can also see the results in terms of growth. Very interesting. Really, really one of the more interesting growth companies. And actually what I'm waiting for in the short term is a possible drop. And then I would buy more. But not too much, because you don't need to invest too much either. If it doesn't work out at all for this company, don't forget it's a commodity product. Fitness supplements aren't exactly revolutionary or unique. So it's really a commodity business and maybe a bit of branding, but risk remains a factor. So the strategy can always fail, of course. Well, the current valuation isn't superior, just neutral. The failure ratio seems very low. But only for this kind of company with a very small market cap. In this case, 150 million, yes. That's in the database, and I trust this database, but you really need to do your own research because the numbers might not be entirely accurate. Now, the EBITDA growth for this year was around 50%, and it can still grow strongly in the coming years. We've also seen what the EPS forecast was. What's also interesting is that the current EBITDA margin is already relatively high, which is definitely intriguing because it's a commodity business. Well, this is what you want to look at. Of course, FitLife Brands, why do I find it super interesting? It's a serial acquirer company, and you can also see that the return on equity is very high, and the return on total capital is already high. And not only that, but the 5-year averages are also high. So this is very promising if you ask me. Zex rank gives a sell. No idea, but just ignore it. And when it comes to a bit of technical analysis, it's really the very last factor you want to consider if you're a long-term investor. But don't forget, it's a game, technical analysis, and there are many players who do play it, and in the short term, it impacts the price. As a long-term investor, you can only benefit from that. What do we see below with the MACD and the stochastics? They are slowly decreasing. The price is also stabilizing. So it could mean two things. So the price will move a bit horizontally for a longer period, or maybe we're lucky and the price will drop in the short term. It would be really nice if it drops by about 30% to the level of early 2024. Then in 2025 we have a great stock to buy. But time will tell. I think the company can really rise significantly in the long term. Time will tell, as I already said. For more interesting growth stocks and opportunities like this, sign up for Happy Investors, check out our website, take a look at Happy Growth Stocks or our other services. For just 30 cents a day, you already have access to interesting growth stocks and also international business investors if you prefer English or are simply English speaking. Then check out our growth stock analysis or other products.
Travelzoo is an interesting small cap company that could surprise in 2025. In 2024, it was a better stock with about 100% return in just 1 year. And for 2025, Travelzoo also seems promising due to exponential growth. It's a small company, an internet company, so a lot can go wrong. But first, let's look at some characteristics that might make it interesting for further research. First of all, we have the Morningstar rating, and I think they want to provide an update. Their fair value estimate right now is $50, while the current price is $21. Looking at some analyst ratings, they indicate that it's a buy with a price target of around $25. But what's more interesting is to look at the fundamental development. The history of Travelzoo is actually quite old, as we can see. What we see here is that the price is coordinated with adjusted appointment earnings. Recently, there has been a huge price spike, and the question is, of course, why? Let's look at a time difference. 7 years, and we'll see a better picture. It seems that the current price, although it has risen to a PE ratio of around 20, still well below its potential. If we look at, for example, the forecasting, we see that analysts, specifically 5 for 2025 and 2 for 2026, have provided a forecast for the EPS, or earnings per share. Now let's assume that this is true. At EPS growth of 20% and 65%, in principle aim for a PE of 30, keep the PE to be 30 because that would be a fair valuation for a fast-growing company, but that might be a bit too risky, so let's just stick with a PE to hold at 15. So if the PE is 15 by the end of 2026 and Travelzoo achieves this quite high profit growth, then it could realize an average return of 15% per year, but with an emphasis on could. A lot can definitely go wrong. And it's very interesting, of course, to see what the current price of the company is, where they are making some changes here and there. Also, look at the management. That's very important. And for the short term, Travelzoo could be interesting, but for the long term, I don't know. We haven't done enough research on that, so you have to be honest about it. Here we show a number of characteristics regarding the loan, including the valuation grade, which at the moment doesn't seem very positive. But this is in comparison to the sector median. If we just look at the numbers purely for the company itself, it's not too bad. It's not a superior company, so indeed the current PE ratio of around 20 is on the higher side. However, adjusted for the EPS growth over the next 5 years, we get a luck ratio of 0.6. That's definitely on the lower side. The price to cash flow is indeed on the higher side for such a small company that doesn't even have a competitive advantage. In fact, it's a commodity really because there's a lot of competition online within the travel sector, so be careful with your money, of course. Market cap is only 250 million. The positive thing is that there are no debts, or at least very little debt. Well, a cash position that is larger than the total debt, so that's definitely a positive in terms of liquidity. Growth figures will look really good. The EBITDA growth for next year is estimated at 27%. EPS growth is even higher than that. A fast graph we saw 22%, here it's 33%. The profitability is actually surprisingly good for this small internet company. Yes, it does have a lot of competition. Moreover, my own portfolio, I have a booking and I think it's one of the better travel agencies, or travel companies I should say. So I stick with high quality, but Travelzoo might surprise in the short term. Zegzarenk gives it a strong buy signal. Their price target for the short term is $24 compared to the $21 we see here. Finally, a very small piece regarding the price and the trends. The current all-time high hasn't been reached yet, but there was a strong resistance level around the price of 20, as we can see here. We can draw a line, of course, then you'll see the same thing. And if you zoom in a bit, you'll see that it has finally broken through that level. So it could be that the stock rises quite a bit further, for example up to 30, or indeed to the 25 that the analysts indicate. Now, that was about Travelzoo. There are of course many more interesting small cap stocks, which is why you should keep subscribing to our channel. We share a lot of free analyses with databases and tools that are paid, which you can also access yourself, but altogether it still costs a lot of money, more than 7,000 euros. So we like to share that through these videos. And if you want access to our database that we use and trust, check the links in the description because there you'll find discount deals, discount links that we've arranged and can offer to our participants and viewers. Argon Inc. is one of the most talked about small cap stocks of 2024 with a return increase of about 240%. Now, of course, the question for 2025 is Argon still a super interesting small cap stock and can it continue to grow? Let's take a look at some characteristics and features of this stock in a quick scan within our databases. Now, the Morningstar fair value estimate is only 105, while the current price is $155. I really assume that it hasn't been updated because there's still very little known about this stock, although it has indeed increased quite a bit by now. There aren't many analysts who have given a rating, so this analysis and data aren't really reliable. When we look at the historical valuation, the history of Argon Inc. actually goes back quite a ways. Suddenly we see that the recent spike does seem like an overreaction and that the stock is overvalued. If we really zoom in on, for example, 7 or 5 years, it seems to be more reasonable. We suddenly see that the recent spike does seem like an overreaction and that the stock is overvalued. If we really zoom in on, for example, 7 or 5 years, it seems to be more reasonable. So there is definitely something going on with this company, and it mainly has to do with the enormous profit growth. Argon Inc. It's actually a kind of construction company that acquires multiple construction companies, in other words, a sort of private equity/investment strategy, and with that, they hopefully achieve higher returns. And for a long time, they've been building on the foundation, not doing a whole lot of acquisitions, but now suddenly profit growth is increasing rapidly. And that profit growth for 2025, as well as for 2026 and 2027, is actually not even estimated to be super high, but it is higher than normal. Now, with the current valuation, which has risen to a PE ratio of 30, an average PE ratio of 24, align with this EPS forecast, and you could achieve an average return of 10%. However, if we look at the benchmark multiple, it actually hovers around 15, for example, 10-year benchmark multiple. Even though this higher profit growth is being realized, if the PE ratio, for whatever reason, drops to 15, you would incur a loss with Argon Inc. So the best might be behind Argon, but it still scores a strong buy on the factor analysis, as you can see here. For whatever reason drops to 15, you would incur a loss with Argon Inc. So the best might be behind Argon, but it still scores a strong buy on the factor analysis, as you can see here. And we use this factor analysis from Seeking Alpha a lot, and it is indeed a reliable indicator for potential outperformance, but with an emphasis on potential outperformance, it might be that the best is already behind us. So why does it score so high? Due to the combination of growth, profitability, but especially momentum and revisions, so the market expects that Argon will make more profit, and we also see that the failure ratio is actually estimated by the data model at 0.33. Now it's clear that manual work is needed to verify if all of this is indeed correct. The market cap is 2 billion, so it's just barely a small cap, and the total debts are actually quite manageable considering the acquisition strategy they employ, and they still have quite a bit of cash on hand. If you look at the revenue growth and also the profit growth, they are indeed very strong. And the EPS growth is also expected to be around 30% for next year. And for the long term, the estimate is actually a bit lower. But the question is how reliable this data is. So personally, I would be a bit more cautious, and I have several actually more interesting serial acquirers in mind, and I also include that in my portfolio. On the portfolio, you'll find many reviews on our YouTube channel, so be sure to subscribe to stay updated on the stock portfolio development and also to access several free analyses that we, of course, share with you. Finally, the six-pack doesn't even have data on Argon, so you don't see that very often. Regarding the technical analysis, I've already mentioned that since 2024, the stock has risen very strongly by about 240%, making it one of the better stocks of the past year. If you look at the history, it goes back a long way. Now you could say, yes, the last all-time high was in 1991, but back then Argon was of course a very different company than it is today. So it's very difficult to determine from this level whether Argon will continue to rise or not. The factor analysis indicates that it's a strong buy. Often this is indeed a good indicator. So here's what's going on. It's also an advantage that there are very few analysts who have reviewed and researched the company. Zegshank doesn't have this information, and there are also very few analysts on Wall Street, only 2 who have dared to make an estimate. All in all, Argon seems promising. I haven't taken a position myself because I mainly have other serial acquirers which, by the way, don't perform that well, like Advice Lab Solution is one example of that. There are a few, but 70 million, and yes, it can easily go up tenfold, but it can also go to 0. Time will tell. Regarding Argon, the question is, can it deliver returns in the long term? We'll see. It could be that the current valuation has risen a bit too much, and that too much is being bought on momentum at the moment.
A promising stock for 2025 is Lending Club with the ticker C. Now we have also reported on Upstart Holdings, which I have had in my portfolio for quite some time. Recently, however, I sold at the huge price peak of the last few months. However, Lending Club seems to have further potential for growth. Now, it's interesting to know that the stock has strong momentum. A number of price targets have been set. Now, the current price is around 17. The Morningstar fair value estimate is estimated at 16.3 stars. That is why analysts from Wall Street are giving a buy signal. They expect the price to rise a bit. Why would you want to invest in Lending Club? Well, I think especially in the short term, because it could benefit from strong growth in loans and due to the higher interest rates, but Lending Club has also secured a major deal with several banks, and that will definitely boost revenue and possibly profit significantly in the short term. There is quite a long history, and especially with the painful long decline, we look at the forecasting with the price to earnings ratio that seems high at first glance at 37. Could that maybe be okay? Why? Because the current EPS is so low that an EPS growth of, for example, 90% can be achieved quickly. And also for 2026, the estimates are relatively high. What could that mean? Let's assume that the price to earnings ratio is around 21 in 2 years, then you have a potential average return of 25% per year. So it's quite interesting, and there are a number of interesting characteristics about Lending Club that would make you want to investigate this company further. Note, investigate further. Now, one of the reliable tools we've been using for years is from Seeking Alpha with their quant data rating. Check the description of our YouTube channel and our YouTube videos for a special link with a big discount on this program, and also see other potentially interesting discount links for the tools we use. Now, why is the stock interesting? Because it scores high on valuation, growth, profitability, momentum, and revisions. And we particularly see from our experience with this tool that if the momentum is strong and revisions are an A+, and the valuation is still okay and growth is good, then you often see a stronger price increase, but it's not 100% science, of course. If you look at the current valuation, it seems a bit high. The PE ratio is not provided, but for non-GAPI it's 2, which isn't interesting. The price to earnings ratio of 830 is also a bit on the high side, but for example, the price to sales ratio is still relatively low. The EV to EBITDA is also not too high at all. And look, the company also has a relatively smaller market cap. It's still a small cap, just under 2 billion. It also has almost no debt. Well, a lot of cash. So yes, that's a very important factor to consider in your valuation when 50% of the market value is in cash. However, of course, it's a financial company, so you need to study the balance sheet and finances carefully. If we look at the growth rate, you might think, hey, B+, how can that be? Here you see all the less positive figures for next year. Well, it does have to do with the expected EPS growth, which is set to rise significantly in the coming period. Time will tell. Also, make sure to check those investor presentations and the annual reports carefully. Never buy without that information. The current margins are not that impressive at all, but this is where the opportunity might actually lie, because Lending Club has closed a number of big deals with banks, and Zexrank also thinks it's a strong buy precisely because of those deals and the strong momentum in lending, higher interest rates, which could lead to increased profitability. Yes, it might actually look better. By the way, the price stock from Zexrank is $19. It's slightly higher than the current price, but at the moment it's very strong. Within our stock alerts, we've been seeing LC coming for a while. We also reported at the last buy signal. We share a buy and sell report every week for more than 500 stocks. You'll find it on our website. Since the last buy signal, it has risen by about 100%. We wouldn't have bought at the first buy signal, but definitely at the third one, because we see that the underlying momentum has been getting stronger. And if you look at the long-term history, the price could still rise considerably compared to 2021. But 2021 was a period of significant overvaluation. So how far the price can actually rise, we don't know for sure, of course. If you maintain the price from 2017, the stock could almost double. If 2017 holds, then the stock could still almost double. So there seems to be potential for an increase from multiple perspectives. The momentum is very strong. Growth figures can be impressive, especially the EPS growth. So there might be something to gain here with Lending Club, but invest wisely and only in companies, Vital Farms is a very interesting small cap stock that could either explode or implode. That's the question, of course. But it is definitely an interesting stock for further exploration. So what does the company do? It sells eggs, keeping it bullshit free. Well, that's what we'll mainly keep doing in this analysis. And one thing to know about eggs is that the whole market is starting to become quite attractive as prices are rising significantly. So right now, egg businesses are doing quite well. Also, take a look at Pilgrim. That's another big egg farm. Now, what's interesting is, and it's good to know this, Interactive Brokers also points out that Wall Street analysts are optimistic, blah, 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 and pay attention. There is, of course, a positive bias. So always be cautious with what analysts say, including us on YouTube videos. Take everything with a grain of salt. Do your own research, in this case also on Vital Farms. And we present this as an interesting small cap idea for 2025 because it has both strong supporters and detractors, and that can certainly lead to significant price breakouts in the short term. Morningstar gives a fair value estimate of 28, which is well below the current price. Interestingly, they indicate an economic moat that is small. Let's dive into why that is. Maybe because of the branding aspect, but not much information is provided by Morningstar. Let's take a look at analyst ratings. They are a bit more positive, 43 price target at the current price of 40. But what's especially interesting about Vital Farms is the potential growth it can achieve, which is of course supported by the entire egg market. The historical listing isn't very long. There's not a lot of information available, and the current price earnings have also risen significantly, namely 35. You can also see two significant price drops here, and the current price earnings is 35. Now, let's say that the current EPS growth estimated by analysts is realized at 10% and 30%. That might not be enough because then the price earnings would have to come out around 20. But often you see that it hovers around 15 or even a bit lower. So Vital Farms can actually go in two directions, either very well or very poorly. And because the current valuation is actually not positive at all, the factor analysis has also been adjusted to a hold instead of a strong buy. So it might be interesting to wait here just a bit short of my price. The linear about that means a bit more. Like with Schmear, a few things still stand out. The loss ratio of 0.2 seems very low, but look at the current valuation. It's on the higher side for a commodity company. Even though they do a bit of branding, I would personally still be very cautious. Well, it's a small plus. Almost no debt, no liabilities, so that's good. Revenue growth is really quite impressive. For next year, an EBITDA growth of 80% is estimated. You see the growth figures? That's why this A0 scores so high in the factor analysis, at least for a longer time, until the valuation has risen significantly again and it has become a hold. We're currently seeing equity very high. We're seeing total capital very high at the moment. Very interesting for the short term, but speculative. I would say it's promising for the next 6 to 12 months. ZegShake gives it a hold rating only for the very long term, especially at the current valuation. I wonder if that's going to be a success. So why on the short term then? Because sometimes the growth can be so strong that the higher expectations are exceeded. Recently there has been a lot of volatility with the price dropping by 36%, and then again by 35%. Then there were also two very strong rebounds, so it seems like there might be a strong support resistance level here. Note that we are long-term investors, but we always make use of the game of technical analysis. This is just a classic example. Here you can see a current support level forming at a previous price peak. And yes, you can say what you want about technical analysis, but in the short term, it definitely has an impact on the price, so make use of it. It would be very interesting to see what the price does right now around 40, and also if it breaks through, what happens to the price at 46. If it breaks through there, it could really take off. The market is starting to become positive again, so it's definitely interesting enough to take a closer look at Vital Farms.